Good afternoon, everybody. Hope everyone's had a fantastic week here in the in the United States. So, like I said, I hope everyone had a great week. It's a little overcast today here in Colorado. We're expecting 2 to 4 inches of snow sometime either this afternoon or this evening. So, I've got a date with the snowblower tomorrow and the shovel. So, I'm very, very excited. I'm sure my wife will help out a little bit, but she's not a big fan of the snow. And part of the deal of living here is I take care of all the snow related duties for the most part. I mean, she helps, but running the snowblower, pushing the snow out of the clearing off the driveway or the sidewalk and putting down the salt and stuff. So that's my job. And if it's snowing too bad, I'll drive her to the airport or whatever if she has a work trip or something. So I'm basically chauffeur, snow removal guy, and also a butler to my 2 wonderful Labradors. So anyways, like I said, I hope everybody had a great week. Pretty nice here in the great state of Colorado. Nice. I tried to clean my ear yesterday, and because my doctor at my physical last week said I had a bunch of wax buildup. So I tried to do it myself, and it wound up getting more clogged. And so I had to go to Walgreens and get an ear cleaning kit. And now I can hear. It's amazing. So, walking around for a day and a half with, this clogged feeling was not the best. It feels like you're in a dive capsule or something, or you have like one of those bells on your head for deep sea diving. So anyways, not that anyone cared enough, gives a damn about my problems. So, like I said, hope everybody had a great week. I know I've said that a bunch of times. If it's your first time watching, please click on the subscribe button. It's probably about right there. And also share it with friends and family. I greatly appreciate it. And they probably get something out of this too. I try to keep this rather light and tell things in a perspective for the layman, because a lot of times people talk in a lot of jargon, and I try to break this down and make it kind of funny too, because when the world's falling apart, you just have to have a little humor. And Jake, I guess, is tired of listening to me, so he's walking towards the door, and he's giving you. He's going to lay down. So, all right, well, let's jump in and take a peek at how the indexes did today. Nothing to write home about. The Dow Jones was down 1.43%, closing at 34,738. The S&P 500 was down 1.9%, closing at 4418. The NASDAQ was down 2.78. It's probably the biggest beating that domestics took, down 2.78%, closing at 13,791. The small caps were down 1.26. The VIX was up 14% today, closing at 2736. Got up as high as 30.99. And I know it got over 30 at least, was at least one time today, because I got my email alert telling me that the VIX was over 30. And, if it's your first time watching, what the VIX is the volatility index based upon the S&P 500. So it's a lot of people call it the fear gauge. And, the way I look at it is anything below a 20 is, a green light. The domestic markets look good. If it's 20 to 30, that's kind of your yellow light. Proceed with caution through the intersection. If you want to run it, you're on your own. And then anything above 30 is a red light. And really be careful with what you're doing in the equity markets, at least domestically. The VIX isn't a very good gauge for international stocks, but gives us a good view of what's going on here in the U.S. All right. So across Canada was slightly up. There were a couple things here. Was this Mexico and Brazil were up, but then the European markets all red until we get down to Budapest or Hungary and Turkey. They were up in their exchanges. And then 2 more greens here. What is this? Saudi Arabia and Japan. They were up slightly, and then the rest of the Asian markets were red, except for Karachi, which is Pakistan, and Sri Lanka. So if you were to look at this from, the entire day across the globe, started out in red, couple greens in the Eastern Europe, and then Western Europe, nothing but red, and then mostly red here in the United States. So, or all red in the United States. All right, well, let me bring up my chart and we can see how things did. Let me close these. You don't care about that stuff. All right, so for the week, Dow Jones was down about 1.17%. The S&P 500 down 2.13. NASDAQ, start at the bottom of the candlestick, was down 3.37. So domestically, that looks like the worst of things. Dow Utilities were down 1.87. And the Dow Transports closed down 1.83. So across the board here in the U.S., it looks like we have nothing but down indexes, and certainly not a good thing. But with a lot of the unknowns and things that are going on from a economic and market perspective, not really shocking. I wouldn't really get too panicked. There's nothing really to worry about. I mean, life's going to go on. Things will fall apart, whether or not it's the US dollar, the US government. The market will, gyrate, with those actions. But, looking at it from the big picture, life goes on. I mean, all we have to really do is look at the Soviet Union. It collapsed in, was it 91, less than 3 years after pulling out of Afghanistan. So if, history is anything, teaches us anything, is that probably the U.S. government will finally collapse, in what, probably less than 2 years. So that's my guess. I don't think we'll even make it to the 2024 election for the next president. So, but, hey, these guys could fix things. They could start paying down the debt. They could start spending less on a federal level, and we could, have peaches and cream for the next 100 years. I just don't think these thieves that run Washington have any, desire to fix things. All right. So let's look at the economic numbers. The U.S. Initial jobless claims this week came in at 223,000. The forecast was 230. Let's take a look at last week's numbers. They were revised up 1,000 from 238 to 239, still below what the forecast was for last week. Continuing jobless claims came in at 1.621 million. Forecast was 1.615, so 6,000 higher than forecast. Last week's numbers were actually revised down from 1.628 million to 1.621 million. That puts it only 1,000 over forecast. So again, the trend still looks good. I mean, if we drag this back out to several months ago, at the end of September, we had about 2.8 million, 2.7 million the first week of October. So we've made some significant progress. I mean, nearly 1 million people are off of the long-term unemployment. So that's a good thing. We still have, 2 or 3 million people that are not in the workforce that were, 2 years ago, but, it's just the way it is, unfortunately, right now. The Consumer Price Index, most of y'all have probably seen the news about this, but for those who hadn't, the CPI number that was released was 7.5% against a forecast of 7.3. And you can see last month's number was a 7, December's was a 6.8, November 6.2. So you can see that, this has been progressively getting higher because we broke over 2% in April of last year. Hey, April 13th, that's my anniversary. And also my grandfather's day passed. Bad day to pass away, Grandpa. But anyway, so we've been over 5%, really since last June. That would have been the May numbers. So we're going on a year of, inflation being greater than, 4%. So we're very close to it. So I'd like to see this number start coming down. However, until interest rates start climbing, I do not foresee that this is going to cease. All right. The Consumer Sentiment Index came in at 61.7. Forecast was 67.5. So that's a bit off. Last month's number was a 67.2. So that's a pretty significant drop. Even going back from, we were kind of teetering around the high 60s, low 70s for a number of months, and for it to drop down to 61.7 is pretty significant. So that shows that of those surveyed, their opinion of what's going on right now is not real high. All right. The Baker Hughes rig count, big jump up to 516 rigs online. We were at 497 last week. So that's 19 rigs in the last week have become operational. So that's a good thing. Again, I'd like to see probably 600 to 700 rigs online. If we could continue jumps like this, we could be very close to that, within 2 months. But again, it's going to depend on a lot of external factors. All right, so I have a few articles I want to breeze through here before we wrap things up for the week. Oil prices spike after U.S. officials say Ukraine invasion expected next week. Now, let me stop there. I have no idea if there's a Ukraine invasion. It seems like those in Washington really, really want it because there's nothing better for getting reelected than a good war. But, I just don't see the point in getting involved in this. This is written by Bharani Krishnan from investing.com. And let's start off. Oil prices spiked Friday with Brent hitting $95 a barrel and U.S. crude almost matching that on White House concerns that Russia will invade Ukraine soon. Even so, WTI settled below the day's high and slightly down for the week after the White House walked back some of its own saber rattling on the Russia-Ukraine conflict. U.S. National Security Advisor Jake Sullivan told a White House media briefing that a Russian attack on Russia could happen by next week and would likely begin with an air assault. Sullivan, however, added that the White House did not claim that Russian leader Vladimir Putin has made a final decision on the matter. That caused oil prices to pull back from their earlier highs. New York traded WTI settled up $3.22 or 3.6% at $93.10 a barrel. WTI hit an intraday high of $94.65 earlier. For the week, though, WTI was down 37 cents or 0.3, registering its first decline after 8 straight weeks of gains. London traded Brent hit a session high of 95.65 before settling at 94.44, up $2.98 a barrel or 3.3%. That put Brent up 1.3% for the week, giving it 8 straight weeks of gains. Aside from the Russia-Ukraine conflict, the International Energy Agency also rattled energy markets by warning that global oil supplies might be dangerously short of demand. The Paris-based IEA, in a monthly report on Friday, lifted its forecast for the year's global oil demand by 800 barrels a day to 3.2 million barrels. What's more, it estimated that there could be a billion barrel shortfall by the end of last year between the Organization of Petroleum Exporting Countries and its allies, known as OPEC Plus, were supposed to have pumped versus actual deliveries to the market since the start of 2021. So billion barrels short over the last year. The oil market is incredibly tight. Toril Bassoni, head of the IEA's Markets and Industry Division, said in a Bloomberg television interview on Friday, prices continue to surge and are now reaching levels that are uncomfortable for consumers across the world. Prior to the Russia-Ukraine brouhaha and the IEA warning, oil prices had lost more than 3% on the week. First, on concerns of Iranian oil supplies could legitimately return to the market through a Tehran West nuclear deal, and later on fears that the Federal Reserve would impose rate hikes as much as 0.5% a month over several months to curb runaway U.S. inflation. So, not good. It's not excellent news. I'd like to see the federal government shut the hell up about the Russia and Ukraine, but again, they want got to keep those boys at Boeing and Lockheed and Raytheon. You got to keep them employed. They can't starve or anything. So, all right, next article. Treasury yields plunge as Ukraine concerns Stokes risk aversion. This comes from Bloomberg. Treasury Treasury surged a rapid U-turn Friday as concern about geopolitical situation in Ukraine and Russia helped spur risk aversion among investors, dragging down yields after a hotter than expected inflation and bets on Federal Reserve policy hawkishness sent them soaring. Treasuries quickly jumped to highs of the day, while volumes spiked higher in 10-year notes futures. U.S. National Security Advisor Jake Sullivan said that the country continues to see signs of Russian escalation. I'm sure they do. Yeah, God, these idiots. Including new forces arriving at the Ukrainian border. Russia has previously denied that it currently has plans to invade Ukraine, and the U.S. said it does not believe Russian President Vladimir Putin has made a final decision. The gain in treasuries pulled the 10-year rate down as much as 10 basis points to 1.93%, temporarily erasing the prior day's advance. Yields plunged across the curve after being buffeted all week by fears of inflation and a hawkish Fed. It looks like USTs are now rallying on some safe haven demand due to Russia tensions, said Brown Brother Harriman and Co. Win thin. Wonder if they're fat. That'd be funny. This sort of haven bid is rarely sustained, and so we think it'll eventually go back to selling USTs next week. The yen, which is generally seen as a haven in times of risk aversion, climbed while the dollar advanced against most other peers, and the Russia ruble slid. With asset prices being pulled to and fro by inflation and geopolitical concerns, tensions in financial markets are running high, wrote BMO's Ian Lingen. So, the finally seeing some uptrend in the treasuries. I would personally be careful and jumping feet first into the treasury market, simply because the only asset of the treasury is the U.S. dollar, and if the dollar collapses, you might get back you'll get back your principal in dollars, but if they're only worth half of what they were when you started, not a great thing. All right. Next article here. Bond veteran says market to see Fed hikes ending near 2%. All right. And this comes from Bloomberg. To a growing faction of Wall Street bond veterans, investors are making a major miscalculation by betting the Federal Reserve's coming cycle of interest rate hikes will end with its key rate not too far from where it is now. As bearishness swept through the markets Thursday after inflation accelerated at a faster rate than expected, traders boosted their expectations for where the Fed funds rate will wind up to around 2%, up almost a full quarter point hike. That still implies a relatively shallow series of increases to below the 2.5% peak in 2018, when the Fed was last tightening monetary policy. But the speed of the adjustment has some strategists betting that it's just the beginning of a broader repricing, as investors recognize that the Fed is finding itself in a much tougher spot than 4 years ago, with growth now surging twice as quickly, wages rising swiftly, and consumer prices jumping by 7.5% in the year through January, the most in 40 years. All of which may push policymakers to drive rates higher than markets expect, threatening to pile more losses on stock and bond investors who've grown accustomed to seeing asset prices rally strongly through eras of easy money. We have this booming economy with high inflation and rapid recovery in the labor market, much different relative to last cycles, said Michael Darda, the chief economist at MKM Partners, who predicts that the Fed's overnight rate will peak at about 3.5%. The Fed is far behind the curve this time. They're going to have to do more. The widespread expectation of a sharp yet shallow rate hike trajectory has been one force that has kept Treasury yields from rising further. It reflects a view that inflation will abate as the pandemic's impacts recede, and the Fed will be restrained by structural forces, including the global savings glut and large debt loads that have left major economies with little ability to withstand rate hikes. I don't think the funds rate will get as high as in 2018. Because on the way higher, stuff will start to happen with the financial markets or the real economy that will make the Fed pause and have to stop, said Joachim Fels, global economic advisor at Pacific Investment Management. We are now in this new environment with the real equilibrium rate of interest probably even lower than it was before the pandemic. The pandemic has also pushed up debt around the world, and monetary stimulus has inflated asset prices. More losses ahead. If others are correct, the Fed and the Fed pushes the overnight rate to 3% or more, that could send treasuries toward what would be the first straight back-to-back annual losses since at least the early 1970s, according to Bloomberg's index. It would also likely pressure stocks, particularly the high-flying growth companies whose heady valuations are particularly sensitive to high rates. If the Fed is really going to be aggressive and get the terminal rate up and shrink their balance sheet, there will be a lot of pressure on stocks for a period of time, said Peter Tichier, head of macro strategy at Academy Securities. Treasuries tumbled after the consumer price index report Thursday, sending 2-year yields up 21 basis points to 1.58 amid increased anticipation that the Fed will raise rates by half a percentage point next month. But early on Friday, yields across the curve edged lower as traders regrouped and some Fed officials pushed back against the idea of aggressive hike coming. Also helping yields retrace Friday were comments from the centrist Fed officials with views that differ from St. Louis Fed President James Bullard, who rattled markets Thursday when he said he favors raising rates a full percentage point by July. San Francisco Fed President Mary Daly said later Thursday that a half-point rate hike is not my preference, speaking to market news. Yet, even with the move, market interest rates are well below levels seen to sufficiently cool economic growth. While the 10-year yield has pushed above 2%, it's still negative on inflation-adjusted basis, given that the bond market is priced in roughly a 2.5% inflation rate over the next decade. Such negative real yields are a sign of how loose monetary policy is still. Despite mounting concerns that the economy is at risk of overheating and inflation is becoming more ingrained than one expected. Inflation is now here, said John Thorndike, co-head of asset allocation at GMO. But the narrative is that inflation is going away and markets tend to struggle with change, he said. It is more likely than not that real yields and policy rates need to move above inflation during this cycle. Past precedent. The apparent lack of market angst about the prospect of a much higher ending rate reflects the difficult balancing act required by the Fed, since a sharp jump in bond yields would tighten financial conditions for a highly indebted economy. That may leave the Fed ruling out an aggressive approach like the one it took in 1994 when it raised rates as much as 0.75 percentage points at a time in favor of a more gradual path it took in 2004 through 2006. Brian Sack, director of global economics for DE Shaw Group and former head of New York's Fed Markets Group, is among those who have said that the Fed will need to lift the funds Fed rate above what the market has been expecting. Economists at Goldman Sachs Group, Inc. have expected it to as well. Goldman's economists bumped up their forecast to a 7 quarter point rate hikes this year, or one at each Fed meeting. In the early trading Friday in Asia, money market traders priced in the same expectation. Rebecca Patterson, director of investment research at Bridgewater Associates, said a lack of investment in housing, commodity costs, and a tight labor market will keep price pressures elevated. We're going to a place where we haven't been in decades. Inflation pressure will persist, she said. While inflation is expected to decline in the coming months as supply issues are resolved, extending trends of rising rents and wages will likely keep pressure on the Fed. A recent survey by the National Association for Business Economics showed that prices charged by U.S. companies have grown more widespread. Wages are soaring, and the majority of firms report shortages of skilled labor. Such economic reports have left Darka, the chief economist at MKM Partners, warning clients on a daily basis not to use the Fed's recent history as a guide to where it's heading this time. The last wars are always fought, and it's not just the last wars are always fought, he said, and it's not just the generals. That doesn't really make a lot of sense. So it seems like those within the Fed or in the different governors of the different Fed branches are not in consensus with what should happen, whether or not it's jacking rates up really high or doing it really slowly or not at all. I imagine those, I'm speculating, but for those who are against increasing the Fed funds rate, it's probably because they don't want to see their portfolios get crushed. And, it's probably a lot of selfishness that's doing that. And unfortunately, the longer we wait, the bigger the problem's going to get. All right. One last article. It has to do with retirement. It's titled, How Much Do I Need to Retire? This was written by Jim Probasco, and it was updated today. A key part of retirement planning is to answer the question, how much do I need to retire? The answer varies by individual and it depends largely on your income now and the lifestyle you want in retirement. Knowing how much you need to save by age can help you stay on track and reach your retirement goals. There are a few simple formulas that you can come up with that you can use to come up with the numbers. How much do I need to retire? Most experts say retirement income should be about 80% of your final pre-retirement annual salary. That means if you make $80,000 annually at retirement, you'll need at least $80,000 per year to have a comfortable lifestyle after leaving the workforce. And that's not always true. Some people are very frugal and they can live on a lot less. Other people, overspend and wind up having to make drastic cuts later on. This amount can be adjusted up or down depending upon other sources of income, such as Social Security, pensions, and part-time employment, as well as factors like your health and desired lifestyle. For example, you might need more than that if you plan to travel extensively during retirement. Retirement rule of thumb, 4% rule. There are different ways to determine how much money you need to save in retirement, save to get the retirement income you want. One easy formula is to divide your annual salary, divide your desired annual retirement income by 4%, which is known as the 4% rule. To generate 80,000 cited above, for example, you would need a nest egg at retirement of about $2 million, 80,000 divided by 0.4. This strategy assumes a 5% return on investment, no additional retirement income such as Social Security, and a lifestyle similar to what you would be living at the time you retire. Keep in mind that your life expectancy plays an important role in determining if the 4% rule will be sustained in general. In general, the 4% rule assumes that you will live for about another 30 years in retirement. Retirees who live longer need to have their portfolio last longer, and medical costs and other expenses can increase as you age. Retirement savings by age. Knowing how much you should save towards retirement at each stage of your life helps you answer that all important question. How much do I need to retire? Here are a few useful formulas that you can use to set age-based savings goals on the road to retirement. Percentage of your salary. To begin, to figure out how much you need to accumulate at various stages of your life, it can be useful to think of it in terms of percentage of your salary. Fidelity Investments suggests saving 15% of your gross salary starting in your 20s and lasting throughout the course of your working life. This includes savings across different retirement accounts and any employer contributions if you have access to a 401k or another employer-sponsored plan. How much to save for retirement age? Fidelity also recommends the following benchmarks based upon a multiple of your annual earnings for how much you should have saved for retirement by the time you reach the following ages. At age 30, 1 times the annual salary, 40, 3 times, 50, 6 times, 60, 8 times, and 67, 10 times the annual salary. An alternative formula. Another more heuristic formula holds that you should save 25% of your gross salary each year, starting in your 20s. That 25 savings figure may sound daunting, but don't forget that includes not only your 401k and matching contributions from your employer, but also other types of retirement savings. If you follow this formula, it should allow you to accumulate your full salary by age 30. Continuing at the same average savings rate, you should yield the following. At age 35, 2 times annual salary, 40, 3 times, 45, 4 times, 50, 5 times, 55, 6 times, 60, 7 times, and by the time you reach 65, 8 times your annual salary. All right, so those are some simple little things there. If anyone wants to read the rest of it, it's just a lot more fluff. But those are some good gauges to know and see where you stand in terms of your retirement plan. Now, if you want to, sit down with someone, I know a guy, me, and I'd be happy to sit down with anyone out there who wants to rerun their retirement analysis to see where they stand, where they have any shortfalls, and maybe help you get back on track or just make it more efficient. So feel free to reach out via email or go to my website, dsafinancialgroup.com, and all the information is there on how to book a meeting. All right. Well, that's everything that I had for today. So I hope everyone has a fantastic weekend. Oh, there's my big boy Barney back there. Yeah, I guess the wife let him out of the office. He was probably getting antsy. But like I said, hope everybody has a great weekend. And I'll be back on Monday with the weekly update. And if anyone needs anything from me, don't hesitate to drop me an email or give me a phone call. And I hope everyone has a great day. Bye-bye.